welcome to the deep dive. Today, we are looking at a puzzle that, honestly, it seemingly defies the basic laws of financial physics.
It really does.
Right, because we are examining a crypto exchange-traded fund that is claiming to pay a massive, and I mean massive, 36% annualized yield.
Which is wild.
Yeah, and distributed directly to your account every single week. But here is the kicker. While they do that, they are simultaneously aiming for long-term capital appreciation of the underlying assets.
All with what they call zero NAV erosion.
Exactly. Zero NAV erosion. So to figure out if the mechanics actually support all this marketing, we have a really robust stack of sources for you today.
We do. We're looking at a highly detailed visual analysis sheet of the BLOX ETF. That's the Nicholas Crypto Income ETF.
Yeah, and that sheet gives us the hard metrics, right? Assets under management, expense ratios, beta, sector exposures, all of that.
Right. And we are cross-referencing that data with an incredibly technical interview transcript from David Nicholas himself. He's the portfolio manager.
And in that interview, he really opens up the hood on the fund's underlying options architecture.
Okay, let's unpack this, because the central conflict here is really about that trade-off between growth and income.
It is. I mean, in traditional finance, if you want high yield, you actively sacrifice capital growth. It's just a rule.
Right. You cap your upside.
Or worse, the fund basically cannibalizes its own principal to pay that distribution to you.
Which is how you get that net asset value, or NAV, erosion.
Exactly. So taking that traditional income model and then grafting it onto cryptocurrency.
Which is, I mean, it's an asset class fundamentally defined by its extreme unpredictable price action.
Yeah, doing that creates this massive structural paradox.
Yeah.
So the mission of this deep dive today is to break down the specific option spreads and the portfolio weights he uses to attempt to isolate that yield without absorbing the catastrophic downside.
Right, because to understand the engineering of this fund, you really have to look at the engineer first.
You do. And David Nicholas, he is not some crypto native developer or, a social media personality who just decided to launch a token one day.
No, not at all. His background is deeply rooted in 20 years of traditional fixed income management for private wealth clients.
He's a bond manager.
He's a bond manager.
And the catalyst for this fund's creation, it wasn't this sudden belief in decentralized finance. It was actually the macroeconomic shock of COVID-19.
Right, because when the Fed slashed interest rates to near zero, the traditional 60-40 portfolio just broke.
Completely broke.
It was an existential crisis for fixed income managers. I mean, you had retirees who relied on a 4 or 5% yield from a standard bond ladder, and suddenly, poof, the risk-free rate just evaporates.
Yeah, and the transcript notes that during the pandemic, for the first time in 15 years, his private wealth clients were demanding U.S. Treasuries.
Just for the perceived safety, even though the real yield, when you adjust for inflation, it was negative.
Right, because corporate bonds weren't compensating you for the default risk, and equities were just in a state of total whiplash.
So he essentially had to figure out how to squeeze yield out of a zero-yield environment.
And he looked at what massive institutional insurance companies were doing.
Right, because annuity providers, they've dealt with low-yield environments for decades.
Yeah, they take your premium capital, park it in boring fixed income, and then use an options overlay.
Exactly, selling calls or doing complex spreads to artificially manufacture yield on top of those conservative assets.
And he packaged that institutional option strategy into his very first ETF, the ticker was FAX, to basically do that on standard treasuries.
Right. But the leap to this crypto fund happened when he realized that this exact same options architecture could be applied to the complete opposite end of the risk spectrum.
Because if you're selling options, your raw materials implied volatility.
Yes. Treasuries have incredibly low implied volatility. So the premiums you collect from selling options on them are relatively small.
But crypto?
Crypto has the highest sustained implied volatility of any major asset class in the world.
So he realized if he ran those same conservative, risk-defined institutional spreads on crypto assets,
the sheer size of the premiums generated would just be astronomical.
Which brings us to his core philosophy, which, honestly, it completely inverts standard income fund logic.
It really does.
I mean, if you pull the prospectus of almost any high-yield covered call ETF, the primary objective is listed as, quote, current income.
Right. But he states unequivocally that the primary objective of this fund is capital appreciation. Current income is entirely secondary.
Which is wild, Targeting a 36% yield as a secondary objective is a massive claim.
Yeah, but he identified a critical psychological barrier for investors. When you put capital into an income fund, getting a huge distribution feels great for the first few months.
Oh, absolutely. Seeing that cash hit the account feels very validating.
But if you check your brokerage statement a year later and your principal investment, your NAV, is down 50 or 60%.
The yield feels like a trap.
Exactly. Even if your total return is flat, seeing your core capital get cut in half creates panic. So he designed the fund specifically to solve that behavioral pain point.
Prioritizing NAV preservation so you aren't just constantly anxious about an eroding principal.
Right.
And our visual analysis sheet gives us the hard data to see if this philosophy is actually surviving contact with the real market.
And it looks like it is. I mean, looking at the metrics, we see an AUM of roughly $110 million.
Yeah, 0.11 billion. And for a niche, actively managed options ETF, crossing that $100 million mark means serious institutional and retail adoption.
Definitely. And the expense ratio sits at 0.75%, which is honestly highly competitive when you consider the constant contract rotation and active options overlay requires.
But the most validating metrics on that sheet are the trend lines.
Yeah, the 3-month and 1-year charts both demonstrate a clear upward trajectory. The 1-year return sits at a positive 7.8%, and the year-to-date is up 5.6%.
Which means the fund is distributing that 36% annualized yield while the actual share price continues to grow.
Exactly.
But, I mean, I have to push back a little here because isn't this basically trying to have your cake and eat it too?
How do you mean?
Well, trying to capture the hypergrowth of crypto while acting as a predictable income vehicle. It's like trying to build a race car that also functions as a dependable city bus. How do you keep the engine from just exploding?
If we connect this to the bigger picture, you have to realize that the engine of the fund isn't just a massive pile of Bitcoin with covered calls sold against it. The portfolio construction is much more granular.
Right, because if it was just Bitcoin, the upside would be heavily capped and the downside would be totally unhedged.
Right. He actually employs what he refers to in the transcript as a Warren Buffett model.
Which is hilarious given Buffett's historical hatred for Bitcoin.
Deeply ironic, yes. But the structural logic actually holds up. The fund doesn't just buy the digital commodity. It buys the entire surrounding infrastructure.
Picks and shovels.
Exactly. He specifically says, I don't just want to own the locomotives. I want to own the company that's putting the tracks down, the coal.
Yeah, the company's building the ecosystem.
Yeah.
So let's dissect the actual holdings, because the portfolio is split into two distinct sleeves.
Right. The first is the crypto sleeve.
And that provides direct exposure to the digital assets, but through highly liquid spot ETFs, not by holding physical coins on a ledger somewhere.
Right. They use HODL and FBTC for Bitcoin and ETH for Ethereum.
And the inclusion of Ethereum is super interesting, right? Because it highlights this strictly quantitative approach he takes, completely detached from the emotional tribalism of crypto.
Oh, the tribalism is intense. But during the fund's construction phase, Ethereum was lagging significantly behind Bitcoin in relative performance.
So from a standard trading perspective, it just presented a larger upside opportunity.
Exactly. He added the Ether exposure despite intense backlash from his own early investors on social media.
Right, all those Bitcoin maximalists who are like, I love the fund, but there's Ether in it, so I don't want it.
Yeah, but the math vindicated the decision. The transcript notes that Ether jumped approximately 50% right around their launch window.
Wow.
Yeah, and capturing that beta significantly boosted the fund's early performance. But, you know, while the crypto sleeve gives you that pure asset exposure, the actual alpha generation, the true engine, resides in the equity sleeve.
Right, the tracks and the coal. So we're looking at custodians and exchanges like Coinbase and Robinhood.
And the semiconductor giants manufacturing the actual hardware, the GPUs, for blockchain validation, so NVIDIA and Taiwan Semiconductor.
And then, of course, the highly concentrated crypto players.
Yeah.
The massive mining operations and corporate treasury holders.
Right, your Riot platforms, Marathon Digital, BitMine, MicroStrategy, Block, Circle, Gemini, Hut 8.
And cross-referencing the transcript with our visual sheet, the sector breakdown aligns perfectly here. It's weighted 31% in technology and 24% in financial services.
Which naturally absorbs those chip makers and exchanges.
But there's a really interesting structural discrepancy to point out here. In the interview, he mentions aiming for a core portfolio of roughly 10 to 15 equity positions, right?
Yeah.
Usually equal weighted around 4%.
Yes.
But the data sheet lists the total number of holdings at 58, with the diversification marked as high.
Yeah, that highlights the hidden complexity of an options overlay. Those 10 to 15 names are just the underlying core equities.
Ah, okay.
But the moment the fund writes an options contract on one of those equities, that contract registers as a separate holding.
So if they own shares of Coinbase and they sell a put on Coinbase and then buy a protective put lower down the chain.
Boom! One equity idea instantly becomes 3 distinct portfolio line items.
Oh, wow. Add the ETFs in their options chains, and reaching 58 distinct holdings happens super fast.
Exactly. And the valuation models he uses to select those core equities are heavily focused on balance sheet disparities. His analysis of Marathon Digital, ticker MARA, is a great example.
Yeah, because at the time of the interview, Mara had a market cap of roughly $5.5 billion. But he wasn't valuing them as a pure tech growth stock.
No, he was valuing them as a discounted proxy for Bitcoin. He pointed out that if you calculate the raw value of the Bitcoin just sitting idle on their balance sheet, that reserve alone approached the total market cap of the company.
Meaning the market was basically pricing the actual day-to-day operations of the mining business at zero.
Right. And when you factor in the $800 million in annualized revenue they generate from their active mining, the stock was just a massive no-brainer value play to him.
Okay, but this brings up a major contradiction we have to address. Mining stocks, like Mara and Riot, they are notoriously brutal holdings.
Oh, very brutal.
They suffer from massive drawdowns. So if I'm buying a fund for stability, why are we packing it with highly volatile mining stocks that have frankly been beaten up lately?
What's fascinating here is that for an option seller, volatility isn't a bug, it's a feature.
How so?
Well, a traditional buy and hold investor fears volatility because it threatens their principal. But an options seller monetizes that fear. When a stock like Mara has violent price swings, the market's expectation of future chaos, the implied volatility, it spikes.
And options pricing models use implied volatility as a primary input, right?
Exactly. The higher the implied volatility, the higher the premium the auction commands. He deliberately holds these high beta equities because they generate the massive premiums he needs to support a 36% yield.
Right. If he just held boring consumer staples, the options premiums would be microscopic.
And the yield would collapse.
That makes total sense. So that forces us to look at the exact mechanics of how they harvest that premium without exposing the NAV to the full force of a crypto crash. Because the strategy isn't a monolith, it's divided entirely by the sleeves.
Let's tackle the crypto sleeve first. For the Bitcoin and Ethereum ETFs, he uses call spreads.
And since you're listening to a deep dive on a complex ETF, you probably already know the fatal flaw of a standard covered call in a high-growth environment.
You surrender all the upside past your strike price.
Exactly. And in crypto, capping your upside is a critical failure. The asset class is defined by sudden parabolic run-ups.
Right. If you sell standard covered calls, you collect your premium, but you completely miss the 40% monthly rallies that justify holding the asset in the first place.
So the call spread is designed to fix this upside ceiling. Walk me through the math of how that functions on the balance sheet. Instead of just selling one call, it's a two-leg transaction, right?
Yeah. Say the fund holds the underlying Bitcoin ETF at $100. They sell a call option at $105. That generates the upfront premium, right? The cash yield.
Okay, got it.
But then they take a fraction of that premium and they go further out of the money and buy a long call at, say, $115.
So this creates a defined window of capped gains between 105 and 115.
Exactly. If the asset closes at 110, the fund is capped at 105. But if Bitcoin goes parabolic and rips to 150...
That long call at 115 activates.
Yes. The fund participates in all the unlimited upside from 115 to 150. They sacrifice a small band of profit in the middle to finance the yield, but the tail risk upside is completely preserved.
That perfectly preserves the moonshot potential of the core crypto assets. But the true differentiator here, what he calls the secret sauce, is the strategy deployed on the equity sleeve.
Because they do not sell calls on the miners and chipmakers.
Right. They sell put spreads. And this is a massive structural shift away from standard income funds.
Huge shift. Because selling a naked put involves agreeing to buy a stock at a specific strike price if it drops, and you collect a premium for taking on that downside risk.
Which, in a bull market, is highly profitable.
But if the underlying stock craters, you are forced to buy the asset at a massive premium to the current market rate. And he points out that if you already own the underlying stock in the portfolio, a naked put creates a leveraged loss.
Because your equity shares are bleeding value, indeed, the put option you sold is compounding that loss simultaneously.
Exactly. Given the historical drawdowns of crypto equities, running naked puts would wipe out the fund's NAV in the first major correction.
So the put spread mitigates this by turning a theoretical unlimited loss into a strictly defined mathematical floor.
Here's where it gets really interesting. Let's use a real estate analogy to visualize this risk transfer.
Yeah, lay on me.
Selling a traditional covered call is like renting out your house for great cash flow, but signing a contract that says if the house doubles in value, your tenant gets to keep all the profit.
Yeah, you secure the income, but you forfeit the wealth generation. Ouch.
Right. Now, selling a put spread operates completely differently. You own your property and you keep 100% of its future appreciation.
Okay.
To generate cash, you sell an insurance policy to your neighbor covering their house, and you collect a large monthly premium. But you know that if a catastrophic fire sweeps the neighborhood, paying out that policy will bankrupt you.
Right, that's the unlimited downside risk.
So you take a small portion of the premium you just collected, and you purchase a deep, out-of-the-money catastrophic reinsurance policy.
Got it. So you keep your properties upside, you get high cash flow from the premium, and your maximum possible loss in a disaster is strictly capped by that backup policy.
Exactly. Mechanically, they sell a put at, say, $95 to harvest the massive implied volatility of the mining stocks, but they immediately buy a protective put at $85.
So if the stock drops to 90, they take a loss on the spread. But if the stock completely collapses to 40 because of some systemic crypto shock,
The bleeding stops exactly at 85. The protective put triggers, capping the fund's downside and preventing a total NAV wipeout.
and the precision of this strategy hinges on their yield targets. He states that the goal for every single options position they execute is an annualized internal yield of 50%.
Right, which is fundamentally disconnected from the 36% distribution yield they actually pay to the shareholder.
Yeah, that 13% delta is their margin of safety.
Exactly. By targeting a 50% internal yield, they generate a surplus. They use a portion to pay the 36% distribution, and the remaining capital is kept inside the fund.
To pay for the protective puts,
Yeah.
the insurance policies.
Yes, and the rest is reinvested to steadily grow the NAV. This surplus generation is the mathematical engine behind that claim of zero NAV erosion. They are simply out-earning their payout ratio.
But wait, they aren't going to be right on every single trade. What happens when Robinhood or Coinbase take a dive? Because he openly admits in the transcript that recent trades on those two names were losers. The equities dropped, and the short puts were heavily challenged.
Yeah, losses happen.
So how does the 50% yield model survive when the core assets are actively losing value?
Because those losses are explicitly modeled into the spread structure. When Robinhood's share price fell, the short put they sold began bleeding capital. But that protective put they bought lower down the chain, it activated and absorbed the impact.
Ah, so they took a localized, defined loss on that specific position, but it was quarantined.
Exactly. The loss didn't cascade and wipe out the premiums generated by the other 14 equity positions.
And there's also a really fascinating internal hedging dynamic that he details regarding how the two different sleeves interact during a market-wide drawdown.
Yeah, because the fund is simultaneously shorting calls on the crypto side and shorting puts on the equity side.
So in a scenario where the entire crypto sector experiences a sharp pullback, the put spreads on the equities trigger those defined losses we just talked about.
Right. However, because the underlying assets are dropping, the call options they sold on the Bitcoin and Ethereum ETFs will expire entirely worthless.
Meaning the fund retains 100% of the massive premiums from those short calls.
Exactly. The profit from the crypto call spreads actively offsets the localized losses from the equity put spreads. The two halves of the portfolio provide a natural internal buoyancy.
Which is brilliant. Okay,
Yeah.
so the underlying math clearly supports the risk mitigation strategy. Now let's transition to the logistics of the payout. Because the 36% yield is distributed weekly, which is highly anomalous, the vast majority of income ETFs distribute monthly or quarterly.
Right. And the origin story of the weekly distribution is honestly a great example of behavioral finance intersecting with social media.
It really is. The initial SEC prospectus for the fund was filed for a standard monthly payout.
But during the pre-launch phase, while he was actually in Europe for his 10-year wedding anniversary, he ran a poll on X, formerly Twitter.
Just asking the crypto community how they preferred their distributions.
And the response from retail investors and financial YouTubers was overwhelmingly in favor of weekly payouts.
So he and his team actually filed a sticker amendment with the SEC prior to launch just to alter the distribution schedule based almost entirely on that social media feedback.
The logic he cites for the change makes a lot of sense, though. He said, why wait until Friday to get paid if I can get paid every Monday?
Right. Distributing the cash on a Monday morning maximizes investor optionality. The shareholder has the entire trading week to deploy that capital.
They can reinvest it into BLOX to accelerate compounding, allocate it to different assets, or just pull it out for personal cash flow. It shifts the liquidity advantage completely back to the investor.
And that weekly cash flow brings up probably the most misunderstood aspect of options-based income funds, the tax classification.
Oh, absolutely.
Because a significant portion of this distribution is categorized as return of capital, or ROC. And when retail investors see ROC on their 1099s, they generally assume the fund is failing. They think it's simply returning their original principal because it couldn't generate real profits.
And to be fair, in poorly managed funds, that assumption is 100% correct. A destructive return of capital occurs when a fund is literally forced to liquidate its own assets to meet a stated distribution yield.
But in the context of a complex options overlay like this, ROC is often just a byproduct of the IRS tax code. It's about how options spreads are reconciled on a balance sheet.
Yes. Let's break down the ledger mechanics of constructive ROC, because it fundamentally changes the after-tax yield for an investor holding this in a standard brokerage account.
Please do.
When you execute an options spread, you have multiple legs open simultaneously. One leg might be heavily in the money, while the other leg is out of the money.
Go.
Even if the overall strategy is highly profitable and generating massive cash premiums, the specific way the IRS requires funds to net out the gains and losses of those overlapping contracts often results in the distributed cash being classified as return of capital.
Rather than ordinary income or short-term capital gain.
Exactly. And he notes that over 80% of the fund's distribution is classified as non-taxable current income.
Which is huge. I mean, if you receive a massive 36% yield every year and 80% of it is shielded from current year income taxes, the compounding power is enormous.
Mechanically, what the ROC classification is doing is deferring the tax liability by lowering your cost basis in the fund.
Wait, so my cost basis goes down. What does that actually mean at tax time?
So, if you purchase shares at $20 and over the course of the year you receive $2 in ROC distributions, you do not pay tax on that $2 today.
Okay.
Instead, your official cost basis is reduced to $18. The tax event is deferred entirely until you finally sell your position, which could be years or decades later.
Oh, wow. And when you do sell, the difference between your adjusted basis and the sale price is typically taxed at the much more favorable long-term capital gains rate.
Right. It effectively acts as a 0% interest loan from the government, allowing you to utilize the cash flow immediately without triggering a massive current year tax burden.
But this efficiency introduces a massive temptation for the portfolio manager. He points out that because the implied volatility in the crypto market is so historically elevated, he could theoretically engineer the options spreads to push the distribution yield up to 80 or 90%.
And pushing the yield to 80% would guarantee an immediate, massive influx of AUM, because retail money consistently chases the highest yield on the leaderboard.
But he refuses to juice the yield past 36%, which is interesting. If the volatility allows for an 80% yield, why artificially cap it?
Because extracting an 80% yield requires writing options much closer to the money. You're taking on drastically higher risk and severely truncating the upside potential of the underlying equities.
So capping it ensures the option strikes are placed far enough out of the money to allow the underlying assets room to run. It protects that primary mandate of capital appreciation.
Exactly. And this raises an important question about the underlying reality of high-yield products in general.
Which is?
If a fund's yield is just based on implied volatility, aren't investors basically just getting paid based on how terrified the market is?
Yes. He explicitly confirms this and provides a very clear warning. He says that if you buy a fund yielding 80%, you must understand that the options market is currently pricing in an 80% implied volatility.
The market is mathematically expecting the underlying asset to potentially experience an 80% price swing over the next year.
Right. Yield is not free money. It's a measure of expected chaos. You are being paid a premium specifically because the market is terrified of the underlying asset's future price action.
So a 36% yield indicates high expected volatility, sure, but it suggests a structural restraint compared to the extreme tail risk implied by funds yielding 80% or more.
Which naturally leads to the necessity of stress testing the strategy. Because the crypto market doesn't just go through mild corrections, it experiences catastrophic, prolonged drawdowns.
Right, the crypto winters. He outlines the historical context, noting there have been 17 distinct Bitcoin declines of over 30% in the last 15 years.
And 30% drawdowns are the mild ones. He specifically points to the 2018 crash, where Bitcoin plummeted 84%, before eventually rallying 500% over the next 3 years.
He calls those brutal crypto winters the standard price of admission for the asset class.
But if a fund is explicitly designed to prevent NAV erosion, an 84% drawdown in the underlying asset is the ultimate systemic threat.
Absolutely. The protective put spreads on the equities provide a mathematical floor, but the fund still requires active macroeconomic management to survive a deep freeze.
And he details his strategy for reducing portfolio beta during a prolonged bear market, right?
Yes. If the macroeconomic indicators signal a sustained crypto winter, the fund doesn't just passively hold the high beta miners and absorb the damage. He actively rotates the equity sleeve.
So he strips out the hyper-volatile, pure-play crypto names like Mara and Riot.
And replaces them with much lower beta, highly diversified technology stalwarts.
So he shifts the capital into mega-cap chip makers and infrastructure companies whose revenues are not directly pegged to the daily spot price of Bitcoin.
Right, this beta rotation dampens the portfolio's overall sensitivity to the crash. And simultaneously, the sheer volume of options income acts as a massive dampening field.
Because if the fund is generating an internal yield of roughly 4% a month on the crypto call spreads, which annualizes to nearly 50%, that cash flow creates a massive buffer.
Exactly. If the underlying Bitcoin ETF drops 30% over a 6-month period, but the fund generated 24% in cash premiums from the options during that exact same window.
The net impact on the NAV is heavily muted. The income fundamentally softens the capital decline.
And this specific dynamic informs his highly contrarian view on dollar cost averaging, or DCA.
Yeah, because the standard retail investing mantra is just to relentlessly buy the dip.
But he argues that DCAing into an income fund with an actively eroding NAV is equivalent to pouring capital into a black hole.
A black hole.
Yeah, think about it. If an income fund's share price is steadily declining by 15% a year because it is cannibalizing its NAV to pay the yield, adding new capital just buys you more exposure to a depreciating asset.
Because the yield you receive will never mathematically outpace the structural decay of your principal.
Exactly. So he wants investors to fundamentally reframe how they view their entry points. He argues that you should be entirely comfortable buying back into the fund at a higher price.
Because as long as the per-share distribution is rising alongside the NAV, you are being rewarded with a compounding, appreciating asset.
It is vastly superior to buying a cheap, dying fund just to capture an unsustainable yield.
And the performance data, since the fund's inception, honestly provides a really interesting test case for this theory.
It does. The transcript notes that since inception around June 17th, the S&P 500 was up approximately 12%.
And spot Bitcoin was up roughly 7%. But during that same window, the fund returned nearly 20%.
He characterizes it as acting similar to a 3x leveraged play on Bitcoin, but without the devastating volatility decay that usually destroys traditional leveraged ETFs.
But wait, if it acts like 3x leverage on the way up, won't it act like a lead balloon on the way down?
Well, our visual sheet provides two crucial metrics that contextualize that performance: the beta and the max drawdown.
Okay, let's look at those.
The listed beta for the fund is 0.95.
And a beta of 1.0 represents the volatility of the broader market, like the S&P.
Right. So a beta of 0.95 indicates that this fund, which is packed with crypto miners and spot Bitcoin, is technically demonstrating slightly less volatility than the S&P 500.
That is a staggering metric. It proves that the put spreads and the internal hedging are successfully domesticating the inherent chaos of the sector.
Furthermore, the listed max drawdown is only negative 12.4%. For any asset with heavy crypto exposure, containing a drawdown to 12% is a massive achievement in active risk management.
However, we have to look at the existential vulnerability of the strategy, because there's always a catch.
There is. He points out that the internal hedge works beautifully in normal market conditions, or even in a standard crypto-specific bear market where the put spreads and call spreads offset each other.
The fatal flaw is a systemic cross-asset liquidity crisis.
Exactly. In a true panic scenario, a macroeconomic shock where correlations across all asset classes go to 1.0, everything crashes simultaneously.
So if the NASDAQ collapses, the chip makers plummet, and Bitcoin drops 40% all in the same week, the internal hedge breaks.
Yeah, the equity put spreads trigger their maximum losses, and the crypto calls, while expiring worthless, cannot generate enough premium to cover the massive equity gap down.
In that environment, algorithmic spreads cannot save the NAV.
Yeah.
The safety net relies entirely on his ability to successfully, actively manage and rotate those 12 equity positions fast enough to stop the bleeding.
The investor is placing ultimate faith in the manager's execution during a panic.
Right. So when you step back and look at the total architecture, this really represents a fascinating attempt to solve the holy grail of income investing.
It really does. They're trying to extract a massive, predictable, weekly yield from the most volatile asset class on the planet.
Essentially, by selling insurance, those put spreads on the picks and shovels of the crypto gold rush without sacrificing the underlying asset's growth.
And whether or not you ever touch a crypto ETF, the mechanics we've explored today are just essential for evaluating any dividend fund in your portfolio.
Absolutely. Understanding how implied volatility generates yield, the tax efficiency of return of capital, and the difference between true total return versus a black hole eroding NAV.
It's critical stuff. But, it leaves us with a final unmentioned idea to mull over.
Oh, what's that?
Well, if institutional strategies like these complex options overlays continue to wrap around Bitcoin and Ethereum, effectively turning wild, decentralized digital money into standardized, yield-generating Wall Street products,
Right.
does that mass financialization ultimately stabilize crypto into just another boring tech sector?
Oh, wow.
I mean, does Wall Street permanently kill the mythical 100x moonshots that drew people to crypto in the first place?
That is a very provocative thought. By making the asset safe enough for everyone, they might eliminate the exact exponential returns that made it famous.
Exactly.
Well, thank you for joining us on this deep dive. Remember to keep questioning your sources and always look for the why behind the numbers. We'll see you next time.